Well, hello, everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Charles Schwab and delighted that you are joining me today for this technical topic. If you are not following me on X, I invite you to do so. My handle at Barb Armstrong CS. We also have the privilege of having Brent Moores with us in the chat. He's a friend and a fellow coach and posts a lot of great stuff on X, formerly known as Twitter. You'll want to follow him there as well. Brent Moores CS. So what are we going to talk about today? Well, I started looking at some charts and I thought today would be a good conversation to talk about breakouts and bounces. So we're going to talk about stocks that are breaking out of different types of patterns and or bouncing, off of those breakouts. And then we're going to look at different ways we might trade those. So we might do a stock trade, we might do a stock trade and an option trade and just compare and contrast them, or different types of option trades. So we're going to do a lot of comparison trades today. So I hope you're buckled up and ready. We've got 45 minutes together and we always try and, pack a lot into that. I want to welcome all of you that are participating in the chat. If you're here for the very first time, please feel free to type a greeting into the chat so that we can kind of formally welcome you to this community. Kevin is saying, I think it's time for coffee again. I haven't had a coffee yet today, but it sure sounds good. So I may just do that after this class. Keep in mind that options, when we look at options example trades, they do carry a high level of risk and aren't suitable for all investors. You have to meet certain requirements to trade options with Schwab. So you've got to apply for option trading privileges. Just want you to be aware of that. This is a technical analysis class. We focus on price patterns, but, understanding the fundamentals, understanding what's going on globally with markets, what's happening with tariffs, what's, happening with the Fed and if they're speaking and how that might influence the markets. Earnings season, we're still in the middle of that. And NVIDIA is coming with earnings today, and that can cause a ripple effect through the markets as well. So, we're not recommending that technical analysis be your only means of making a decision. It's one of the components, okay? So just wanted to lay that out there. And as much as we wish it were otherwise, past performance doesn't guarantee future results. So I've got one quick announcement. We're going to spend very little time on the market overview because there is a market kind of what's going on in the markets overview every morning at the market open. And today, Ben Watson and Brent Moores did a fantastic job of that. So I encourage you to go back and watch that opening class because it is archived. We're going to place some new example trades, and I'm coming back after a 6-week hiatus, so we don't have a ton to manage yet, but we'll talk a little bit about trade management as well. So the one thing I want to bring your attention to, we do have another event prior to the Dallas Market Drive in Washington, D.C., a 2-day workshop, but it is maxed out. So we are stuffed to the gills on that one. And these events are free to attend, but if you have never been to a market drive and you are within striking distance, or you just like to go to Chicago for a weekend or Dallas or head for Orlando, that's a 2-day event happening in Orlando. But these market drives, we go from what's happening globally, what's happening within our country or our markets here in the U.S., what things might be impacting those markets. We look at individual sectors and then we come right down to individual stocks. So, these are great to attend and there is no charge. We will provide breakfast, we will provide a lunch, and actually we'll provide a really nice reception at the end of the day. I will be in both Dallas and Chicago, would love the chance to meet you. So if you're there, please come up and introduce yourself. And for some of you, I'll be seeing you again, because we've had the chance to meet in the past. But I got introduced to this world of trading through a live event back in 2011, and I still love attending these. So welcome to Dennis. He's saying it is his first time. Spot, I don't remember what the spot trade was, but So Jack has typed something into the chat saying that in the trading a smaller account class, I do treat that trading a smaller account, which is Mondays and Fridays, as a companion class. I do treat this class as a companion class to that. So sometimes trades that we place in today's class will follow up in that Friday or Monday. So just so you know, because these are both active trading classes. And by that, I mean that we place a lot of example trades and then we follow up on those example trades. So without further ado, let's get out to the markets and start looking at some charts. So here's the S&P 500, and it looks like we should add a little room to the upside here. So I'm going to come to my sprocket, and we're going to come to the price axis. And since more stocks seem to be moving bullishly than bearishly, we'll add some room at the top rather than having room at the bottom. There we go. And so, the S&P 500, not at an all-time high, but within, for an index trading at 6,477, within $4 of it. So you don't even have to have a good arm to throw and hit it from there. Yeah. Yep. So, close to an all-time high, continuing to uptrend. NASDAQ, not quite as close to the all-time high, but not that far away from it either. Since, this April low back here on the 6th or 7th, it has just been uptrending. I mean, it's been an extraordinary move. I think up about 40%. Pardon me, 41. Not too shabby, right? Now, when we look at the Dow, now the difference between the Dow and the other two indexes, the SPY, the S&P 500 and the NASDAQ, is that this is based on the price of the stock, not based on the market cap of the company. So, when Apple did a 4-for-1 split, its influence on this index fell by 75%. And, the same when NVIDIA did a 10-for-1 split. But, we're close to an all-time high on this index as well. And it's certainly been uptrending just like the others. And then the Russell, which is our small caps, new high today. So, and these charts, there's a similar feel to all of them, right? And then when we look at our volatility index, sitting at 15, which is in the lower end of the range of where it has been year to date. So, that is an indication that, there's confidence. Yeah, somebody's saying that they went to the 2-day event in Chicago and it was great. Someone else went to the 2-day event in New York and that was great. I'm really sad when I have to miss those. So somebody's asking, where can I go online to see where these classes are offered? And so if I just bring up, good question. So let's just take a second and I'll show you. So we're going to come to schwab.com/coaching. And then you're going to come to in-person events. So the next event is December 12th and 13th in DC. The first day is technical analysis, second day, an introduction to options. Then we've got these market drives in Dallas and Chicago, then a 2-day event in Orlando. You can come, things are posted right out to the end of the year. In November, the weekend before Thanksgiving, an event in Market Drive in Anaheim. Then there's a 2-day event in Houston at the beginning of December. And then the weekend before the Christmas holiday, there's a 2-day workshop in Miami. Okay. So we've got lots still to come this year. Okay. Now, if you want to see, somebody said they were just new to these webcasts. So if you want to see that, just come to live webcasts and virtual workshops. And if you come down here, we are on Wednesday. So when we look at Wednesday, we had trader talks, trading index options, managing an options portfolio, and then trading price patterns. And then we have 3 more to come. Then there's getting started with Thinkorswim, trading growth and value stocks, and then market and sector analysis with Connie Hill today. Okay, so you can see we teach live classes all day long, all through the week. Chance is asking, are there live events in Los Angeles? When it comes to the beginning of the year, we'll have several events, in the LA area. But most of those events have already happened this year. But, stay tuned because we do a lot in California. Okay, so let's get back to our regular programming. Okay, so that's just a very quick overview. Let's come and look now at some things that have been moving to the upside. And Google is one of the heaviest hitters on both the NASDAQ and the S&P 500. I did a little video last week on the S&P 500. I'm going to do another one on the NASDAQ on Friday, and just, who are the heaviest hitters, the stocks that have the most influence and which sectors have the most influence. And we can see here, Google created this big V pattern, and then it came and broke out. We had a 1-day pullback, and it's moving, back to the upside. And so when we look at this pattern yesterday is called a Harami pattern, where, the body of this pattern is totally inside the body of the day before. Now, some might look at this and say, well, hey, we had kind of a bull flag and then it came up. Is this not bearish? And it could be. Or you could look at it and say, I look at this as breaking out above a resistance level, and this is establishing a new support level. So it just depends on how you look at it. But if we looked at this from a bullish perspective as a breakout or a breakthrough, this, resistance level, and then look at yesterday as the retest, could we do something like a long call vertical? And, why would I default to a long call vertical as opposed to buying the stock? Well, it's heavily traded, so the opportunity might be there. So that's one reason. 2, it's a $200 stock. So if we wanted to buy 100 shares, and we don't have to buy 100 shares, but if we wanted to buy 100 shares, that would be out of our snack bracket with a $30,000 account. So that might kind of come into play as well. And if the overall market is bullish and the communication sector is bullish, and if we come and we look at sectors here, and we say, which have been the strongest sectors, we've got information technology. So tech is number 1, communications number 2. And, if we come to the Analyze tab, Google, communications stock, so strong sector, strong market, strong uptrend. So if we look at this and say, okay, well, let's come out and say it's trading at 207, and we kind of try and bracket. So we've got, over 12 million contracts or 12 million shares of the stock have traded today. We've got 20,000 contracts on the books at the 205 strike. And, 2,500 at the 207.50. It's almost at 207.50 now. So it would only have to move less than 20 cents for us to have our max gain. What would we have to pay for that? Well, 140. So how much could we lose? 140. And if we wanted a 50% gain, our max gain would be if it reached 250. But if we're saying, hey, if it could get to 210, we'd be happy campers. That would be a 50% gain in 23 calendar days. So if we're willing to risk up to $500, could we, do, we could do 4 contracts. But some people might be thinking, well, why are we doing a 250 wide strike? Because if we do 4 contracts, then we have to pay more commissions. But if we look at the 210, it has to go up more. It has to go up now 2 and through 210. So instead of having to go up by 25 cents, it has to go up by $2 and it has to go up by $2.70. Has to go, and that may not be a stretch for Google at all to make the same, we're going to go for the same 50% return. So I said we do some comparing and contrasting. So let's do one that's a 250 wide strike and one that's a $5 wide strike. So we'll do 2 at the 250 strike. So if this is at 258 times 1.5, 387 would be our target. Well, 390. So we're going to take our single order, make it a first trigger sequence, right click, and create an opposite order. Now, if you're new to this trading strategy, a long call vertical, the goal is for it to go through both strikes and stay above that. And, we don't want to be greedy. We want a 50% return as opposed to close to 100% return, which is, what we could potentially make. 242 divided by 258. That's a 94% return. We're saying, hey, we don't want to be greedy. If we can make 50%, we're happy. Okay, so we're going to put this in our long call vertical group and we're going to compare to the 250 wide strike. Now, some traders tend to lead to the narrower strikes. And they don't worry as much about the commissions because, the commissions, if it costs you $1.30 per contract to get in and $1.30 to get out, it's $2.60, it's $5. But, your probability of it expiring, both strikes in the money is going to be higher with the smaller strike, with the, tighter strike. So we're going to come here again. We're going to buy our vertical and we're just going to compare these and we're going to do 2. So we're risking similar amounts and single order, first trigger sequence, right click, opposite order. And we're not risking $500 per trade here. We're risking about $500 in total. 135 times 1.5. So that's about $2.02. And I just took 138 and multiplied it by 1.5. Good till canceled. So how much could we lose here? 276. We could lose all of it. And our max profit, 224. And we're saying, hey, if we can make about a 50% gain, like I said, happy camper. So we're going to come down here and we're going to compare this to the $5 wide strike. Okay, so that is Google. Let's come and look at Baker. So what are we seeing with Baker? Remember I said we were going to talk about breakouts and bounces? Like, is this really breaking out? Well, since it hit this low back here on April 7th, it actually has been just kind of moving along to the upside, right? Right. And then we had the last earnings report. It gapped up dramatically and then kept going. And then it's pulled back. And yes, this was it kind of pulled back almost where it started its run after this earnings, but it hasn't closed below the 30-day moving average. And then we had, if we're looking for a breakout here, if I'm playing I Spy with my little eye, could we call that, it's hit 1, 2, 3. When you draw your line, there's just a bit of an art to technical analysis. You're just trying to hit as many wicks and bodies as you can. So, we had this breakout on the 21st, and then it really moved quite dramatically the next day. We had a 1-day pullback, and now it's moving to the upside again. So when we see this breakout and kind of retest, what could we do? So we could do a swing trade, and this is a $44 stock. So this is in our snack bracket if we wanted to buy 100 shares. Now, we don't always just limit ourselves to stocks that we can buy 100 shares of. Sometimes we've bought 8 shares of something, or 12 shares, or 40 shares. But if this is heavily traded, and it's sitting at almost $45, could we maybe buy this and sell a covered call to a buy right covered call? We could. Could we just buy the stock and do a swing trade and say, hey, when it gets back to 46.50, sell it? Well, we could do that too. Or, could we do a long call and say, which is buying a call and say, I want to buy this call when it gets back up to 47 or 46.50, when it gets there, and do it. We could do a swing trade with that. So let's look at the options. Well, one, this only offers monthly options. So that tells us that, these may or may not be heavily traded. But if we look here, out to October, we've got a lot of volume here. And if we look at this 47, so if we wanted to do a buy right out that far, we'd be paid $1 for that, 90 cents to $1. And you may say, well, that's not much, but it's over 2%, because, $1 would be 2% at 50. So it's not nothing, beats poking the eye with a sharp stick, as I like to say. So if we come and we look at buying, and the terminology on the Thinkorswim platform is to buy covered stock. So if I looked at this and it says, okay, I'm paying $43.97 to get in. If I buy 100 shares, sell the covered call, the most I can make is $47 if in fact I get called out. So if I said, okay, 47 minus $3.04, we could just call it $3. Oh, what am I doing here? Well, I want to take my $3.04 is what sometimes I just can't talk and type at the same time. $3.04 divided by 43.96. That's a 6.9% return potentially that we could make. Now, what could we lose? Well, if we don't put an exit in, we could lose $4,000. And if we're saying, well, we don't want to risk, $4,000, we don't want to risk more than 500. Where might we put a stop? Well, we might say, hey, it kind of gapped up here. If we look at this as a potential support level around 43.61, we could say 43.61 times 0.97. If we went 3% below that, our stop would be around 42.30. So that would kind of be just maybe below this diagonal resistance line. And it's also below the 30-day moving average, which has been acting as a nice support level. And so if we're looking at this and thinking, well, hopefully we won't end up stopped out, but if our stop is triggered, it's obviously not going in the right direction. Now, if this continues to move up, can we adjust our stop? Sure, we can. Okay, so we're going to come to our trade tab. We are buying covered stock. And the way we are going to put in our exit, we're going to come to single order, first trigger sequence. Then we right click anywhere on these two green lines, create an opposite order. We're going to make it a market order. Why is that? Well, we're making it a market order because we don't know exactly what the price of the option will be, but we're saying, hey, if Baker goes below 42.30, not going in the right direction, so please buy this back and close it out. And when it triggers a market order, you know, if the stock were to gap down, we could end up out at a lower price. So it doesn't guarantee. But if we're out at 42.30, you know, we're risking $2-ish, $1.60-ish for the opportunity to maybe make $4. So that seems like, you know, some traders might think that was a pretty reasonable trade-off. Oh, it's saying 307. I misspoke. We don't stand to make $400. We stand to make 307, potentially. And we'll talk about trade management on this as we go. Okay, now we're going to compare this to a long call, because I said today was a comparison day. So we're going to do a long call. So with a long call, if we were to buy this call here, the October call, the 45 call, which it's almost trading at, saying you've got, you know, a 98% chance it's going to come up and hit 45. Well, it's what we call the at the money strike. Now, when we buy a call, how much money could we lose? We could lose all of it. So we're going to put in the same target here. Well, we're going to do a swing target on this one. So we're going to come up, we're going to buy custom with an OCO bracket, because we want to put a target in, and our target is going to be, this previous high was, well, our previous close was around 46.55. So we're going to put in a target of 46.50. So we're going to say, hey, I don't know how much this is going to be, what it's going to be worth, but when the stock gets up to 46.50, whatever it's worth, sell it. So, whoops, not at or below. If it goes at or above 46.50, we want to sell it. And with a swing trade, often we don't put in a stop based on the price of the stock. We say, hey, you know what? We're expecting this to move and move relatively quickly. If it doesn't, if it gets to the point, you know, and at $1.85, you might say, well, if it gets to the point where it's worth 90 cents, which is about, it's lost half its value, then let's just call it a day. And so we're going to do 2 contracts, which means we're risking just shy of $400, and we're putting in a stop at a 50% loss. Now, some might say, well, Barb, if you're putting in a stop at a 50% loss, why aren't we doing 4 contracts? Because even though when you come to confirm and send, sorry, those have to match, it says we're risking 370. You know, we could really risk double that because our stop is at 50%. But what if the stop gaps down? We could lose more. So we're trying to be conservative in our approach and conservative in our position sizing. And some people might say, oh, conservative, schmervative, like, come on, I want to make money. Well, you know what? You could throw your shoulder out for patting yourself on the back when things go your way, but what if they don't? And what if it's just not this trade? What if the whole market tanks and you have like 10 bullish positions on, and now you're taking double the losses on all of them, or a much more significant loss. And then you're on the bed, curled up in the fetal position, sucking your thumb and wishing you'd been more conservative. So, we're just erring a little on the side of caution, but that's a personal choice, but I get asked about this. And so this is why, we're having this conversation. All right. So we're going to come down here to long calls, and we're going to compare this to our buy right covered call. Yeah. Yeah. And trust me, Kelly, like it does hurt. We had this happen. I was in Maui on vacation. I couldn't access my paper money account. We had like 10 bullish trades on. We took a $2,700 hit on a $20,000 account in 1 week. And that can happen. Because, when we do our long call verticals, let's come to the monitor tab. And we've done a long call vertical example today. In fact, we did 2 on Google. So the deal is we put in a target to get out, and we put the target into the system to get out if it goes up 50%. We monitor it every day. Here's us monitoring our long call verticals. Are any of them close to 50% up? No, because we put them all in the last week since I've been back. Are any of them, and actually a couple of them we're now out of, we've already hit our targets. Are any of them down close to 50%? No. But if they hit a 50% loss, then we go in and we exit the position. When I was in Maui, I couldn't exit. So we took much bigger than the 50% loss we were, planning on taking. Yeah. Ouch. Ouch is right. And I mean, we did just fine by the end of the year, in that paper money account, but that was a pretty tough week. And, everybody likes to talk about their successes. Nobody likes to talk about their failures. But I think that sometimes we can learn more, when there's a tuition fee assigned to it, if you will. And that $2,700 tuition fee, it wasn't nothing. So, okay. So that's that. How about we come and look at, RTX was the very first one on my list. So let's look at RTX. And you may be saying, like, who is this RTX that we speak of? And we did a trade in our Getting Started with Technical Analysis class last week on this. We did a buy right covered call. And so if we come and look at this is in the other account, just since we're talking about RTX and we're talking about buy right covered calls. So we're only up $139 on this. I think we placed this last Tuesday, few trades, August 21st. So that was this day. And so one of the things about doing a buy right that can be kind of nice is that if it doesn't quite go your way, if you buy the call, time decay starts eating your lunch, and, it can erode the value of the option. But when you buy the stock, you still own the stock. So if it starts going sideways at the end of 30 days, it still is worth a similar amount. Now, today we sold this 160. It went up just a little bit above. It's now sitting just a little shy below. And you can be called out at any time. Now, if we're called out, we're going to go like, yay, applause, applause, because we just hit our max gain faster than we were expecting. But if it pulls back sometime between now and I think it's September 19th, if it pulls back, then the value of this option will erode. We get to keep the premium or the majority of it, and then we could just sell another one, do a wash, rinse, repeat. But so in our smaller account class, so let's go back to that. It's like you're saying, well, our max position size is 5,000. So we can't afford to do this thing that, you guys in a different snack bracket are doing. Does this mean that we just can't trade this? And so we placed this trade last week based on a diagonal resistance breakout. And I'm just going to get rid of this line just to unclutter the chart. But from let me just, this is trading price patterns. Some might look at this and say, well, hey, it's now broken out above the previous high and it's kind of retesting. Now, when I last looked at this candlestick was not red. But I mean, it is down by like 3 cents on the day. So, but you know what? It now is a red candle, which could be indicating that, this breakout may turn out to be a fake out. We're hitting a new all-time high. I believe it's an all-time high on this stock. Yes, we are. So, maybe we wait. I'm going to be filling in for James Boyd tomorrow, and we're going to talk about trading the trend. So we will look at this one again, maybe tomorrow or Friday, in trading a smaller account. Oh, look at that. Now it's green. Like, she loves me not. But could we do this idea of the long call vertical again? And is it heavily traded? Are there enough, to make it worth our while? So like I said, it's waffling, so we'll pass on that. But let's come and look at Cisco. Yeah, the trend is our friend until it ends. And so here's one, when I said breakouts and bounces, this is why I threw in the bounce, because if we look a little further back, like just step back a little, what do we see here? Well, I see kind of this cup and handle type pattern here, that occurred from what? February through when it broke out in June. And then it kind of came up, hit a high of 72.55 and came back down, and it's bounced off this support level. So this is kind of the second time it's come back around this 66 level, and it's moving to the upside again. And we've got momentum in the market. How is the tech sector doing? Well, let's come over and look. Well, number one in the hit parade, close to an all-time high. So the tech sector's been pretty strong. Lawrence, if you're having trouble with Thinkorswim, you may want to sign out and sign back in again. I'd always recommend that as the first, just to reboot and see how things are going. So the S&P 500, the tech sector's been strong, and Cisco up 15% year to date, even after this, long, consolidation period. But could we look at this and say, could we do maybe the 65 and the 70? My guess is they probably have 250. Oh, they have dollar-wide strikes. So if we're thinking in this next few weeks, now what's the advantage of a shorter time frame? Well, if you're 23 days, if it moves up dramatically in the next few days, it might hit your target faster, but you then have less time to recover if it doesn't. And so, we're going to do, just so again, because I'm in this compare and contrast thing today, so we've done one where we compared and contrasted. We're going to compare two different strategies, a buy right cover call and a long call. And we did that on Baker. Then on Google, we did two long call verticals and we're comparing strike widths. This time, we're going to compare time frames. And so we're going to do one here, time frames and strikes, because it's sitting at 68.50. So it's not going to be a total like apples to apples. But we're going to do, so here, it only has to go up by 50 cents to get our max gain. And it's sitting at 56. So 56 times 1.5. So when it gets to 84%, we've got our max gain. Now, if we want to make it a little closer to apples, we might do this 68 and 70. And I think that when we come to October, we'll be doing a 250 strike. So we'll be doing the 67.50 and the 70. So we'll do the 68 and the 70. We're going to do, we'll risk 300, single order, first trigger sequence, right click, and we'll make this $1.50. So when it's up by 50%, we want out. Good till canceled. And then how much are we risking? So again, the idea is that Cisco continue to move up through that 70 strike and then stay there. And so, and this expires in 23 days. And we're going to compare this to the October expiration. Okay. So that's the first one. Now we're going to come out to October and we're going to do the 67.50. And we've got like thousands of contracts of, you know, a 6-cent bid-ask spread. This is a very heavily traded stock, both in the options arena and in the stock. So we're going to do 2 contracts here. So we're risking, you know, a similar amount, single order, first trigger sequence. And again, this has to go up through 70. So the top strike is the same. Create an opposite order, 133 times 1.5. So we want to exit when it's $1.99. We could make it $2. $2. It was $1.99.5. So today, actually, we did 6 trades, or you could call it 3 pairs of trades that we're going to compare and contrast in upcoming classes. I also have a series called the Trade Management Mini Sessions. And I could end up putting some of those in there where I just record a post-mortem. If I do that, I will let you know to September expiration. And just so you know where to find those, you're going to want to go, you're going to want to, you know, as we wrap up, I always say this, regardless, you are going to want to subscribe to the Trader Talks channel from Schwab Coaching. And there's a couple of reasons, you know, it's free for you to subscribe, but this is where all the archives live. So if you want to go back and watch the trading price pattern class from last week, you can easily do that. Or if you want to do a binge learning, if you come to these trade management mini sessions, oh, look at these just got posted. I'm going to post these on X. So I recorded these yesterday. It's kind of what is a bearish Harami and bullish Harami. These are very short videos on, you know, different candlestick patterns. And it's a good complement to the Getting Started series. But also, oops, didn't mean to do that. Sorry. I've created a bunch of example trading plans. And today we did several long call vertical trades. So if you want to go through an example trading plan, it's a framework from which you can create your own. Here's one. Here's a long call example trading plan, a buy right covered call example trading plan. And then if you're newer to all of this, if you scroll down to the very bottom, there's a whole bunch of short videos on just Thinkorswim. Okay, so guys, that's a wrap for today. Please hit the like button. It helps move this up in the trading algorithms, on YouTube, so more people can find this content. Subscribe to the channel. Follow Brent and I in the land of X, Brent Moore CS and Barb Armstrong CS. And yeah, that's a wrap. I don't think there was a survey today, so you're off the hook there, but stay tuned. There's lots of great content still to come today. And I will see you tomorrow in Trading the Trend. Take care, everyone. Bye for now.